Let's bring in Shane Oliver, Head of Investment Strategy and Chief Economist at AMP Capital, managing around about $100 billion in assets roughly there. Shane Oliver, how would you actually characterise what's been happening over the last couple of days?
Well, I think it's quite simple, really. Stocks became oversold on the back of global growth worries, which have been triggered by a whole series of events in Europe and the US, and were due for a bounce. And, of course, Bernanke has provided that in the context of keeping interest rates low for the next 2 years and alluding to quantitative easing. So I think really it just has to be seen as a bit of a bounce from very oversold levels. Have we seen the bottom? I think it's too early to tell. Normally, after markets fall so much, and falls were of the order of 20% from the highs earlier this year, you normally need to see a bit of base building, and so far we haven't seen that. But I think the Fed is part of the solution here. There's not much more the US government can do, but I am hopeful we will see another round of quantitative easing, and ultimately that will set the stage for a decent rally into year end, but it may be a bit too early to anticipate that just now.
Shane, will it work? I mean, would another round work? I had a guest yesterday, Todd Martin from Societe Generale, saying that he expects QE3, but he doesn't see any point in it unless he has unless the Fed produces also a package which is going to create jobs. Do you agree with that?
I do have some sympathy with that view, and you'd have to question whether QE2 worked. It was announced, implemented formally starting last November, and continued up until June this year, but through the first half of this year, as we all know, US growth was pretty subdued, so hardly any benefit there. That said, Ben Bernanke and the Fed, or key members of the Fed anyway, they're not all in agreement at the moment, would probably argue that firstly they have to do something and have to give it a go. To not do anything risks the US economy sliding into recession and deflation. Obviously the US government can't do more in terms of fiscal stimulus, so it really does come back to the Fed. And Bernanke would probably argue that were it not for QE2, the risk of deflation and recession would probably have been higher than turned out to be the case. So I think they'll give it another go, regardless of whether it's going to work or not. But I think they'll certainly give it a try.
Right, well, how does that play into your investment strategy? Do you re-rate your stock picks now? Do you re-rate the sectoral plays that you have if you're assuming that you do have another round of this printing of money?
Yeah, I think it's incumbent upon investors to sort of look at the parts of the share market, the sectors and the stocks that benefited from QE2. And obviously there you're looking at the cyclical parts in the market, materials, industrials, particularly, and obviously it's more of a negative for the defensive plays. And of course that also fits in with the swings in valuation recently, where we've seen sharp falls in cyclical shares, particularly material stocks, but they would be a key beneficiary of any move towards QE3. I think the next date to watch on this, the critical date, will be the 26th of August, because that's when the Jackson Hole, Wyoming gathering of central bankers occurs, and if Bernanke is going to foreshadow it, I think that's where it's going to really come from.
So at the moment, how do you position yourself, Shane? I mean, I know that you like pharmaceuticals and some of these consumer staples here. What else? Well, over the last little while, we've been pretty cautious on stocks. We've sort of moved into slight underweights in terms of our overall positions in shares, and the portfolios have been somewhat defensive in nature. I think now that looks like we're coming into some sort of low, I'd like to think we've seen it, but we could see stocks bounce up a little bit from here over the next couple of months, or have a little bit of volatility over the next couple of months. I think the key for investors, including ourselves, is to look at parts of the market that have been sold off the most, and then starting to reduce that defensive exposure back towards some of the cyclicals that will benefit from QE3. Shane, thanks a lot for that. Shane Oliver there joining us from Sydney. He's at AMP Capital. Right, we've got to take a break.